If you've been having a hard time reading candlestick charts, this episode is for you. I remember a time when I was getting started when I looked at a candlestick chart and I said to myself, I don't see anything. It's like I'm looking at a foreign language. And it's true that this is a language. This is the universal language of the financial markets. And it doesn't matter if you're trading Forex, cryptocurrency futures, or you're trading stock. When you learn to read candlestick charts the right way, you will see the subtle buy and sell signals that are on every chart. The reason most traders mess this up is because they're overcomplicating it and they're looking at the wrong type of charts. I'm going to clear all of that up for you in today's episode. So we're going to go ahead and jump into the slide deck, how to read candlestick charts, and I'm going to walk you through the 3 simple steps that I took that made finally reading candlestick charts click. Now, I struggled with this, and the reason that I struggled was because when I was getting started as a trader, I had a small account, as many of you may have today, and I felt like I couldn't afford loss. I could not afford to make mistakes. My back was kind of up against the wall. Just to give you context, when I was learning to trade, I was in my 20s. I had a college degree, but it was the Great Recession. The economy sucked, and I couldn't get a regular job, and I basically had no savings. I was running out of money. And so I was in a position where I needed to make this thing work. My goal was to make $200 a day, roughly $1,000 a week, $50,000 a year. That for me at that time was like a dream, and I wasn't achieving it. So when I was setting up my candlestick charts, I was doing everything possible to reduce my likelihood of what I thought would be loss. And I ended up creating these incredibly complex charts. I'm a little embarrassed to even show this to you. This is an actual candlestick chart that I was using at one point. You can barely even see the candlesticks. They're up here on this top panel. There are more than 20 different indicators on this chart right now. So step 1, I'm going to tell you guys, fewer indicators is better. And I'm going to show you which ones you should be using. But the reason fewer is better is because when you have that many indicators, it's literally impossible to check all of them before you take a trade. And you can end up getting conflicting signals because you've got so many indicators you're trying to rely on. So what I really needed to do, to be honest, was address that fear of loss that was so deep inside me. I was so scared of losing. And one of the ways I was able to kind of break free from that was by beginning to trade with really small share size. So when I would take losses, they weren't as emotional because I made a mistake that a lot of beginner traders make, that when I first got started, I was trading with big size and I incurred a few huge what felt at the time to be huge losses. They wouldn't be relative to where I'm at now, but at the time they were really big, and it was so disheartening. I was so frustrated. I just felt like, the world was ending if I couldn't figure this thing out. And so I was trading with this kind of like, it was like crazy, but it was like almost like Russian roulette. Like every time I took a trade, I was like, oh God, is this going to be the one? And I had so much fear in me that I couldn't focus. I couldn't see straight. So I was adding all these indicators because I was searching for the Holy Grail. Now, some of you may have been on the hunt and not even realized it. The Holy Grail, so to speak, is the perfect indicator that will always tell you when to buy, exactly when to sell, and you will never lose money. Man, that would be awesome. It would be awesome. And I hate to break the bad news that it doesn't exist. There is no such thing out there as a Holy Grail indicator that's never wrong. And there's no such thing as a trader that doesn't, from time to time, lose money. And just to inspire you, just a little bit, and this isn't to brag, it's just to kind of put it out there, though, and show you, this is $12.6 million of real money. Third-party audited broker statements. You can see it on my website if you want. This is real money that I've made, and I did it while being right only 68.6% of the time. In other words, I'm wrong 30% of the time, and I'm still making money. And that's because, of course, I've figured out how to have a good profit loss ratio. My accuracy is pretty decent, and I'm choosing the right instruments to trade every single day. But let's get back to these candlestick charts. So hopefully that's a little inspiring for you. Although I'll remind you that my results are not typical. This is pretty exceptional. Hopefully it inspires you, because for me, one of the things that kept me going was knowing that there were other traders out there that were making money. Because, if everyone was losing, 100% of people were losing, it was like, no. But just the fact that there were a few people out there that were doing well, that gave me hope. So you're telling me there's a chance. Okay, so fewer indicators is better. There's no doubt about that. What I would say is these are the indicators that I'm going to encourage you to use. Okay, so number one, we're going to keep it simple. We're going to use moving averages, and I'm going to use exponential moving averages, and these are the ones I'm going to use: the 9, the 20, and the 200. Those are 3 exponential moving averages. Now, the way I set it up, my 200 is in magenta, my 9 is in kind of a gray color, and my 20 is in blue. So now let's jump onto the chart real quick, and I'll actually show you these indicators. Okay, so this is just a very clean example of a chart, and if I full screen this, I mean, I don't really probably have to compare it to what you just saw, because this is obviously much, much easier to read. I mean, it's almost like the difference between a very messy, disorganized room or, office or whatever, and something that is like clean and clear, right? So this is what you want. You want a nice, clean, simple chart. So we've got the 9 exponential moving average here. This is our fastest exponential moving average. A moving average takes the average price over the X number of periods. And so this is a 9 moving average. So it's giving you the average price over the last 9 candles. And it's going to move the fastest with price action. This is the average price over the last 20 candles. It's going to move a little slower than the 9. And this is the average price over the last 200 candles. The 200 period moving average is very well respected. A lot of people use the 10 and the 20 and the 50 and the 100. I use the 9. I actually like it just a little bit more than the 10. It's just like a little bit faster. I like the 20, and I don't find the 50 or the 100 necessary. They're just extra unnecessary indicators on my chart, and if I'm not using them, it makes my chart messy, and I don't need it. So we've got 3 moving averages: the 9, the 20, and the 200. Now, the other indicator that you're going to want is your volume weighted average price. So indicator number 2 is VWAP, volume weighted average price, and this is going to be, it's a standard indicator, and I do it in an orange dotted line just like that. Now, your volume weighted average price here, just make that cleaner. Your volume weighted average price is like a moving average, except that it also factors in the volume that occurred. There it is. So this is actually in solid, but you could have it either in a solid line or a dotted line, whichever one you prefer. So this is factoring in the amount of volume that occurs at price, and the volume weighted moving average, volume weighted average price is the equilibrium point for the day. So it is the exact average price for the period of the day. So if the price is above average, it's bullish. If it's below average, it's bearish. So as a very simple way of thinking about it, if something is below the volume weighted average price, the bears are in control. If it's above, the bulls are in control. And generally, as a long bias trader, I'm going to focus on trading when the price is above VWAP. So down here, we dipped below it just for a moment, and then the bulls regained control and it got back above it. All right. So we've got our 9 EMA, our 20 EMA, our 200 EMA, our volume weighted average price. Then, of course, we need volume bars. So number 3, volume bars. And volume bars have to be colored based on the close and open of the candles. So you cannot have volume bars, for instance, that are all the same color. This would be a mistake. These are our volume bars right here. And what we're actually going to do here, I'm going to go full screen this, just the volume bars. And I'm going to demonstrate for you how important this is. If these were all the same color, what we would miss is it would be hard to understand sentiment. So I'll just make them all the same color here just for a second and just kind of show you what this looks like. Oops. Okay. Oops. This way. All right. So if these are all the same color, all we know is that we've got a lot of volume, but I can't tell from this where the price is going. Can you? I would imagine you can't. It's impossible. Now let's add, for growing volume, we're going to change this back to green here. And even if you didn't make this one red, you of course know the inverse is going to be red. So now this is painting a picture. What this is telling us is on these candles right here, we certainly had high volume, kind of out of nowhere, high buying volume came in. What this is communicating is the imbalance that's occurring between buyers and sellers. So during this period of time right now, who's dominating? Just based on the volume profile, the volume profile is telling us that the buyers are dominating. So we can almost certainly assume that the price was moving up. We probably moved up here, we pulled back for a second, we moved up more, we pulled back again, we moved up a little bit, we dipped down, maybe a little higher, dip, a couple red candles, so dipping down a little bit more, maybe coming back up for a second, and then going into a little bit of a period of pulling back. We start to pop up for a second, and then we kind of pull back again. All right, so now let's pull up the chart and see how that lines up. Okay, so you could actually almost trade exclusively on volume bars without candlestick charts at all. They're that significant. And likewise, to trade without volume bars, you would be almost trading with one eye closed. Because while the candles are moving up, it's very important to understand the volume profile because this gives you context. So let's just say, for instance, that the price is moving up. So we're going to do some green candles here. Let's just say that the price is moving up, but the volume is declining. Those are the volume bars. And then when you have a red candle here, let's just imagine that the selling volume is like this. What story does that tell? The imbalance is clearly to the sell side. While there were buyers, they were diminishing. And then when the sellers came in, they dominated. What about the inverse? Volume increasing as it's moving up. And when it pulls back, light volume. Now, this is the information that we need in order to make an accurate prediction at what's going to happen next. The traders who can predict the future the best will be the ones who make the most money. And what we're doing as traders is we're getting really good at pattern recognition. Now, what I struggled with as a beginner was that, for one, I couldn't see the patterns. I couldn't see the trees through the forest because I had so many indicators on my charts. I couldn't see the patterns. Trying to visualize patterns, the subtle patterns of an indicator is... The problem is the indicator is a derivative of the actual price. So I don't know a really good analogy for it off the top of my head, but to me, it makes a lot more sense to pay attention to the price. It's almost like trying to do everything like looking in a mirror, looking in a reflection. Like just look at the actual source because that's where you're gonna get the cleanest information. So the source is here, the candles. The indicators provide context, and that's helpful, but you can't only have indicators. When you only have indicators, you can't make accurate predictions because the best patterns are going to occur on the candlestick chart itself. And then what you're going to do is you're going to use these indicators, your moving averages, your volume weighted average price, your volume, and then this one right here, which I'll talk about in a second. You're going to use these to help you essentially validate that this is doing what you think it's going to do. Okay, so in this case right here, the prediction changed significantly based on the two volume profiles. So we'll do a second version right here where we have decreasing volume as we go higher. And then we have these candles here with high selling volume. So now if we start to make a move back up, I would predict that the buying volume would be very low and that we would end up at best double topping at the high of day with this being resistance for a move back lower. And at the worst, it wouldn't even make a new high. It would just keep going lower and lower. And I certainly would not be buying dips or pullbacks in this area here thinking it's going to move higher. There's no way I would do that. On this chart, on the other hand, if we're pulling back right here, and that's our 9 moving average, and then our 20 is down here, and our VWAP is down here a little lower, I would look at this and I would say, I should be a buyer near the support of the 9 moving average right here. The volume profile tells me there's an imbalance to the buy side. If I buy right here near support, I can set my stop at the low of this candle right down here. And I can add as the price moves higher. And this is a chart where I would expect to see strong resolution to the upside. Now, this is an example. This is a real chart, and this is a real stock that I traded. And I'll show you the P&L that I had on this stock a little bit later in this class. So we have our first move up here on high volume, nice volume. We have a momentary pullback, and then it pushes even higher. We have here a little bit of a more proper pullback. And again, look at the volume profile. Nice high volume buying. as it was moving higher, and then a light volume candle right here that's red. It dips down for a second, and this is the spot to be a buyer right down here. While you certainly could buy as the pattern comes back up to the top, you could also be accumulating right here on this pullback because the volume profile is supporting the belief that this is going to move higher. The buyers are in control. And when buyers are in control, the dips get bought up and the price moves higher. It pulls back again, buyers are still in control, and the price moves even higher. Now, the fourth indicator that you're going to see is on my charts is the MACD. So the MACD stands for Moving Average Convergence Divergence Indicator. And this is an oscillating indicator. So it goes like this, and it has a signal line that goes like this. And what I do with this indicator is I focus on trading when the MACD is above the signal line. So you've got your signal line here, which is in orange, and then you've got your MACD, which is the which basically what this is doing is it's taking the moving averages and it's telling you when they're converging or diverging. So here the moving averages are diverging, they're moving apart, right? Do you see how those moving averages are moving apart? They move apart when the price is moving quickly. The price moves quickly, the moving averages pull away from each other. When the price starts to contract and come back together, the moving averages converge. And during the bear market of 2022 and then the rally in 2023, I found that by only trading when the MACD is open, that greatly reduced the number of false breakouts I had. So this is an indicator that is helpful to look at as, sort of in a way, red light, green light. If the MACD is positive above the signal line, I'm interested. If it's negative, I'm not interested. And so on this chart right here, when that crossed over, right at this point, that was the place where I would say, nope, I'm not interested anymore. Now, you could create kind of a complex overlay like this, and you could make it very easy to not miss it. But unfortunately, when you start doing this, it's very easy. Just look at how much messier this chart looks. It's not easy to see. And what you don't want to lose sight of are these clean, simple patterns right here, because this really is going to be where you're going to find the most success. So step one is simplifying your indicators. You can see on my chart how simple it looks. It's just not worth overcomplicating it. So you really want to keep it simple. This is what my charts look like, and this is what it looks like whether it's a 1 minute, a 5 minute, a 10-second, a daily chart. They're the same. I just keep it really simple. Okay, so now let's pull the slide deck back up here for a second. All right, so step one is fewer indicators is better. Step two is focusing on what is obvious. This was a huge mistake that I made when I was getting started. When I was getting started, I wasn't focusing on what was obvious. My problem was that I started focusing on stocks that I knew. And now it doesn't matter whether you're trading futures or Forex or you're trading cryptocurrency, you want to trade what is obvious. So let me just pull the charts back up here and show you an example of what I mean. So on this particular day, I would say without question, this was the obvious stock to trade. It ended up going up 100%. It had news. It was on my scanner right here. I saw it when it was up like 69%. These are scanners that are searching the market for stocks that are moving, but you can use scanners like this for commodities, for Forex pairs, and for cryptocurrencies as well. Now, the problem that I got into is that I started trading things that I knew. So I pull up a chart on IBM, and I'm like, I know IBM computers. And I'd start looking at this chart, and this is when I said, I don't see a gosh darn thing. I'm looking at this chart and it's just, I got nothing. I pull up a chart on US Steel, X. This is a company that I was familiar with. I see nothing. I pull up American Electric Power. This is another stock that I had for a while that I focused on a lot. Oops, AEP. Pulled up American Electric Power. I got nothing. This thing makes, I just don't see anything here. There's not clear patterns. And this was the biggest mistake that I was making. I was trading things that I was familiar with. I was not trading things that were actually volatile or worthy of my attention on that particular day. By the way, if you want to download a PDF of my strategy, it breaks down my criteria for finding the best stocks to trade and where I'm getting in and what exit indicators I'm using to tell me when to get out. You can download the PDF. It is linked to the top comment. I pinned it, and it's also linked in the top of the description. So make sure you download it, print it out, and start practicing trading this strategy in a simulator. Of course, this is the strategy that I've been trading for more than a decade. It works in today's market. So I would encourage you to study it as much as possible and see if you can find success with it, because it's incorporating everything we're talking about in today's episode. So here was my reasoning. I had heard some people say you should get really good at trading like one or two stocks. Get really good at trading like Apple, for example, or the S&P 500. And some people do this with Bitcoin or with gold. Just get really good at trading, one financial instrument. Once you start to kind of learn its patterns, you'll start to get comfortable and you'll get better at it. That was not true for me. That was never true. I wasn't able to actually get dialed in. And to be honest, I think it's kind of a myth, because now with more than a decade of experience trading full time, I don't know any traders who actually make a living trading like that. I've known a few people who were very wealthy who bought positions in some of these stocks like Tesla or Apple and would kind of trade around them. Sometimes they would buy more shares on one day. The price would go up, they'd sell them. But if the price went down, they would just keep holding them because they believed in what they were buying. And that's not really day trading. And to be honest, for traders like myself who are getting started with small accounts, you can't afford to do that. So it just didn't make sense. So this was the big problem for me, is I was not trading what was obvious. So what is a better way to define and help you understand what is obvious? What I look for is high relative volume. So let's define what that means. Some of you may be familiar with this phrase, others are not. So we're looking for, the abbreviation is just RV for relative volume. And what I have found in my metrics is that I make the most money when the relative volume is 5 times higher than its average. And I can actually back this up with this $12.6 million in profit. So we're going to look here. Let's see what it is. It's under, let's see, under instrument. Okay, so we're going to pull this up. What we're looking for here, oh no, maybe it's days. Oh, well, let's just check. No, it is here. So performance by instrument relative volume right here. So this shows over $10 million of my profit came from stocks that had at least 500% higher, which is 5 times higher relative volume relative to the 50-day average. And then the rest, for the most part, was on stocks that were between 150 and 200. But in fact, look at this. These are losses when I'm trading stocks that have lower relative volume. That's very interesting. Now, what is this essentially telling us? The reason that I'm making money on stocks that have high relative volume is because high relative volume is a byproduct typically of a news catalyst. When you have breaking news, and you can have breaking news and a day where Bitcoin is really hot, or a day when Apple is really hot. It'll usually happen like 4 times a year when they're putting out their quarterly earnings, at least in the case of stocks. But there can be global events that create a catalyst for futures, for future commodities, for gold, things like that, for Bitcoin and currency pairs. So whatever it is, you need the catalyst. The catalyst is what's going to create that high volume. So now let's look at this chart in a little bit of a different way. We're going to move this out of the way. I'm going to look at the daily chart here on American Electric Power. And if we look at the daily chart and we just look at the volume, you could see a few days here that have higher volume. Here, a little bit here, a little bit here, a little bit here. So these would be the days that it has higher relative volume. Even in spite of that, the relative volume ratio, these peaks are maybe twice the average. They're not that high. This one's a little higher, but they're really not that high. Let's look at Tesla. So we're going to look at the volume peaks on Tesla. There aren't many peaks. It has sustained high volume, but the relative volume is not particularly high, except back here this day was very high volume. Okay, so that day right there, that's a day that I would say, okay, maybe we could consider trading it on that type of day when you have, significantly higher volume. Let's look at the S&P 500. For those of you that try to trade the S&P every single day, when does the S&P have high relative volume? Basically never. Let's get real. This is the S&P 500. This doesn't have usually single days with crazy high volume. You had in March of 2020 when the market dropped 30%. That was the highest pretty much relative volume spike that I had seen. And so on that particular day, yes, and this sort of stretch, these 2 weeks, this was an opportunity if you really wanted to trade the S&P 500. Although what I'll say is that there were individual stocks that were even more volatile that are within the S&P 500 that were driving this move that would have been better candidates for trading. So on any given day, you're looking at these large cap stocks, American Electric Power, US Steel, ExxonMobil, whatever. These are not volatile enough. Occasionally you'll have higher relative volume, but even when you do more or less the price action, there's nothing here to look at. So it made sense when I said, I'm not seeing anything here because I was focusing on the wrong stocks to trade. Now, for me, getting focused on the right stocks to trade, the ones that had the 5 times higher relative volume, this only came after a really big loss that I took that blew up my account. Well, it put my account so I had to deposit more money to keep trading. The account wasn't negative, which could be if you have a really big mistake. But in any case, I had to add more money to my account. And so during the period where I couldn't trade until I added more money, I went through all of my metrics, and that's when I began to notice this pattern. What I was trying to figure out was, okay, I've been doing this for 18 months. Where are my winners? Where are my losers? What am I doing right, if anything? I mean, I was feeling pretty defeated, so I wasn't sure I was really doing anything right. But I looked through my metrics, and this is what I noticed. My profits predominantly, most consistently, were when we had high relative volume. It was also when the instrument was up more than 10%. Okay, so the opening gap being more than 2%, but the instrument being up 10%. So then all of a sudden it's like, well, wait a second. This for me was a really big deal because when is the S&P 500 ever up 10%? When is Apple ever up 10%? Never. I mean, not in one day. It doesn't happen. So then all of a sudden it was like, well, wait a second. So then where am I making money? And again, these are real metrics from real money trades. And my hope for you is that by looking at this, you're able to sort of understand the anatomy of the strategy that I'm trading every single day. And it's a strategy that is working in the market today. So my performance is predominantly on lower priced stocks. While you'll see that I do have some that are higher price, GameStop, right? I traded that when it was higher price and a few others. Predominantly, my profit is under $20, between $2 and $20. That's really my window where I've got the most profit. So I was like, okay, well, so we know we're looking for a relative volume of at least 5 times higher. We know that we're looking for, so this is number 1. Number 2, we know that the price needs to be up 10%. Number 3, all right, we're looking for a catalyst because the catalyst is what's creating the interest. That's what drives the move. That's where the relative volume starts to move up. It doesn't move up if you don't have some type of catalyst, right? And then let's see, we'll get out another marker. Number 4, we're looking for price between 2 and 20. Right? So now we're starting to get a little dialed in. This is how you start to build a strategy, right? This is how you build a strategy. You've got some parameters, and now I can start searching the market every single day for stocks or commodities, or currency pairs, it wouldn't matter, that meet these parameters for being worth considering. Okay, so let's see. So let's back this out here for a second. All right. So let's see. We're going to jump back over to here. So I'm using my scanners to find this all in real time. So these scanners are actually searching the market. They're scanning the entire market. And then what I do, once I see something that's on my scanner, like I did right here in the case of WISA, is I say, well, what's the catalyst? What is driving this move? I see that we've got news on it. Jumps on announcing fourth HD TV PTV license with major TV brand. Okay, so that's the catalyst. Now, I don't have to be an expert on this stock. I don't have to be an expert at this industry. All I need to know is that there's a news catalyst. The price is up 10%. We've got high relative volume. The price fits within my wheelhouse of 2 to 20. And from there, it's game time. All right. So I pull up the chart and boom, nearly $10,000 right here, trading this move up. So I know that this, for some of you guys who are newer, you're like, I don't even have $9,000 in my account. I don't even have 900 in my account. So I'm not going to have $9,000 winners anytime soon. Fair enough. But to inspire you and to show you someone who's been doing this for a while is able to extract this kind of profit from this kind of move, I hope will help you get focused on trying to find these setups in your own trading and get really good at reading these charts. So what we really want to be doing is making sure, number one, we're keeping our indicators very simple. Number two, we're trading what's obvious. And number three, you want to build a strategy around what's working. So you want to throw this out right here. This is way too complicated. This is obviously not where you're going to find success. And you want to lean in on trading these types of patterns where you're seeing good resolution. So this, again, it's just a screen grab from a day where, up 3,500 on the day total. But look at the patterns here. Now, this is a little higher priced, which made it a little riskier for me. But look at this move from 36, pull back up to 40, pull back up to 50. That's really clean. You see a chart like that and you're like, wow. I mean, yeah, that makes sense. I want to be buying this pullback. But again, we're only buying that pullback when the volume profile checks out, when the MACD is open, right? We still have to check our indicators. We got to make sure all of our indicators are checking out before we're taking that trade. But if everything checks out, then that's where we're going to step up to the plate. We're going to say, all right, I'm going to jump in here. I like this setup. So this is another example here. You've got 1, 2, 3, 4 candles moving up. We've got high volume green candles, green bars. This is preferred. Sort of a light volume pullback right here. We dip back down. The first candle makes the new high. And for me, that's the moment where I'm a buyer. So the way I think of these charts, and I think of this because it's what's happening, is I think of these waves. So if you think of a wave coming in, you first get this move up, and there are some people who are going to buy down here and just jump in. But to be honest, the candlestick chart's not supporting that entry. People who are buying here are kind of chasing the move, and you'll have people that chase the move, and that's fine. People can do as they'd like, but that's not really a good setup. I like to wait for that first wave to pull back a little bit. And this is the moment of truth, because this is where the volume profile is going to either tell us high volume selling. This is when the MACD is going to cross over. We're going to break below our moving averages, or we're going to hold. And if we hold, then at that moment, I can now visualize the rest of the pattern. I know what's coming next. So now what I'm looking for is the moment that the wave sort of shifts. So if you think of the tide coming in, the wave going out, and then you're looking for that next wave to come back in. So the way I do this is I'm looking at my indicators, I'm looking at my chart, and I usually in this area here, while we're still selling off actively, I'm starting to think, okay, MACD's open, the volume profile is acceptable. I want to start looking for an entry. And what I begin to look for is the first candle to make a new high. So we'll actually draw it on this side. So when we're talking about first candle to make a new high, this is something that is so important for timing these waves. So we've got the price moving up, and then we've got the dip back down right here. And the second we have a candle right here that breaks the high of the previous candle, that's where I'm getting in. So something that we talk about a lot is candles making new highs. See, each of these candles are breaking the high of the previous candle. That's the high of the previous candle right here. That's the high, it broke it. That's the high, it broke it. That's the high, it broke it. That's the high. So the high of this candle breaks it, right? And then when we're pulling back, candles are usually making new lows. See how these candles are making a new low, a new low, a new low? Now, if it keeps making new lows, I'm not going to buy. I'm not just going to get in down here. I'm going to wait for the first candle to make a new high right there. Now, these patterns, the way these types of stocks trade is they can be very clean early in the move. New high, new high, new high, new low, new low, new low, new high, new high, new high, new high. And the reason they're like that is because there's a catalyst that's driving the volume. If there wasn't a catalyst driving the volume, you wouldn't have it. But when you have a catalyst, you have news that's pushing it higher, pushing it higher, pushing it higher, pushing it higher. And honestly, let's just ask ourselves, what's the first candle that actually made a new low? It's not until all the way right here. That was the first candle that made a new low. These pulled back, but they didn't actually make a new low. And then this right here, none of these made a new low. The low of that candle, that red candle, this one was not as low. So we had one candle that made a new low right there. And then we didn't have another one until right here. 2 candles made new lows in that whole stretch. So if you bought at this first candle that made a new low, I mean, you wouldn't want to buy, but basically you bought because you said, okay, this is the wave. This is the first wave. It dipped down. And then as soon as that next candle makes the new high, that's where you're in. So basically right after that candle made a low, that's going to be your lowest risk entry. And the reason that's the lowest risk entry is because where do you set your stop loss? Where do you bail out if this doesn't work? The low. You bail out at the low right there. So now this is where you start to get dialed in because you're thinking, I'm getting in right here. My stop is right here. Let's just say that's 10 cents a share. Now, if I can make 20 cents a share on this position, I'm going to have a 2-to-1 profit to loss ratio, right? A 2-to-1 profit to loss ratio means if you're right even just 33% of the time, you're break even. That's your break even 33%. If you're right half the time, 50%, you're profitable. Now, if you had a 1-to-1 ratio, 10 cent winners, 10 cent losers, 50% would be your break even. You need to be a little higher to be profitable. Okay. Now, as you saw from my metrics, my accuracy is about 68%, and that's produced 12.6 million in gross profit. Okay. So you see how this comes together. It's the combination of profit loss ratio and your accuracy that creates profitability. So what you're looking at here is let the first wave happen, let it move up, and then look for that first dip back down, that first pullback. Candle makes a new low, and then right after that, the first candle that makes a new high, that's where you're a buyer. Again, as long as your indicators are supporting it. These are the only indicators I'm using right now. And I only recently added MACD. So for a long time, I didn't even use that. But in a bear market, in a choppier market, I found it helpful. So I've kept things really simple for a long time, and I've done well as a result. You don't need to overcomplicate it. So you let it squeeze up, you let it pull back, and then you're getting in on that first dip. Now, one of the challenges that a lot of beginner traders have is they'll get in right here, and then they're gonna sell right here. They're like, I'm out, I'm selling. And then they watch this thing, squeeze all the way up, to way up here, something like that. It just keeps moving higher. And they're like, well, holy smokes, I sold right here for a tiny profit. Meanwhile, this thing went like way higher. You could have had like a 5-to-1 profit to loss ratio, but you sold early with a 1-to-1 ratio. You do that too much, what you're going to do is you're going to set the bar higher than necessary for you to be a break-even trader. So here's what I would suggest. You're going to have that instinct to sell. I had it myself. Why did I have it? I had a small account. As soon as I had a winner, I was like, boom, I got to get out of this trade. I don't want to overstay my welcome. I don't want to lose it. Fear of loss, right? So once again, that fear of loss creeps back in and it's telling me to bail. As soon as I've got a little profit, sell. Because the sooner I sell, the sooner I've locked it up and made the winner real, and it's not going to turn into a loser. So here's what I started doing. I set up hotkeys on my computer. So I have these, and I'll show you here just for a second. So you can see here. So these are the keys that I use. And the way I have it set up is Shift 1 is to buy, and Control Z is to sell my full position. and this is selling at the bid. Control X sells half of my position at the bid. Control C sells a quarter of my position. And so what I did was I actually took away the sell full position. I changed the script on it to only sell half my position because my instinct was to bail out when I was up just a teeny amount. I said, the only thing I need to just start, rewriting that. And so when I have the urge to sell the whole thing, I'm going to change the script on that button. So I'm only selling half of my position. And that was a real game changer for me because it kept me in my position longer, at least half of it. But at the same time, it sort of did give me that little bit of gratification that I needed of like locking up a small winner. And after I've sold half, I adjust my stop to break even on the rest of the position. So now I have guaranteed that this is going to be a winner. Now, eventually, I got better at not selling half until I saw an exit indicator. So what do exit indicators look like? When we're looking at a stock chart and we're looking at these candlesticks, the exit indicator is the first candle that makes a new low. So if you've been holding this whole way up and you didn't sell any of it, then as soon as you have a candle making a new low, that is an exit indicator, because at that point, you don't know how much this is going to pull back. Now, as it turns out, selling down here wouldn't have been great, and you would have actually gotten right back in a moment later. But as a beginner trader, you have to have a set of rules that you follow. And so you hold until that first candle makes a new low. Now, what some traders will do is they'll scale out, selling half or a quarter, scaling out a little bit into profit. And there's nothing wrong with doing that, especially when you have big green candles like this. Because when you have these kind of big green candles, if you don't sell until the first candle goes red, well, now this is kind of a large amount that you ended up giving back as it came back down. So that's when you do want to start taking profit into a move. So when I first get into a trade, what do I want to see? Number one, I want to see that when I first get in, if I'm getting in down here, right, if this is my entry right there, what are the things that I want to see? So let's list them out with a marker that's working well. So number one, I want to see the price move up, right? Price should move up. Obviously, if I timed my entry correctly and I got into the first candle to make a new high, the wave is already moving up. So I should be getting in here and the wave should just continue higher. So that's not a big ask for the price to move up. Should it move up? I would say at least 10 cents within 1 minute of entering the trade, just to quantify it a little bit more. So like it should move up pretty quickly. Number two, I want to see buyers on the time and sales, which should be, in other words, green on the tape. So when we're looking at the level two, we want to see, we've got the bid on the left, we've got the ask on the right. So you've got something that's like 550 by 560, let's say, and then you have your time and sales window usually right next to it. And this is where what we want to see is a bunch of buy orders going through 560, 565, 570. Green on the tape, we want to see a lot of buyers, okay? These are the two things I absolutely want to see. I'd also like to see large green candles, okay? Large green candles. So now let's inverse that. We'll invert it. So if I want to see all of those things in order to feel good about a trade, in order for me to see an exit indicator, a reason to sell would be I get in and the price is not moving. So if I got in right here and the price doesn't go up 10 cents in a minute, I'm going to get out. If there are not any buyers or green on the tape, I'm going to get out. If there are not any large green candles, I'm going to get out. And what might happen, just for instance, is I'll have an instance where I got in and then the next candle goes red and I get right out. Now, this would not be typical if we had a good volume profile and if all of our indicators checked out. But the fact is, my accuracy is 68% of the time. So 32% of the time, I'm going to be wrong. I'm going to have the right idea, but I'll be wrong, and I just have to cut my loss quickly. But if I get in and the price moves higher, and then up around here, let's say, right around this area, the price sort of stops moving. We stop seeing buyers on the level two. We start seeing red on the tape, or we start to see the formation of a red candle. Those are exit indicators. So we start to get a small red candle up there. right? That's an exit indicator. The price is now moving down. We now have sellers on the tape, and we're having a red candle. It's the opposite of a green candle. So sometimes what can be helpful is when I think about everything I want to see for this trade to work, I then invert those, and those are my exit indicators. So my exit indicators here are essentially when I'm not seeing all of the things I need to see for the price to be moving up. That has been really helpful for me. Now, if you had the discipline to not sell until you saw an actual exit indicator, you would do really well. Because most traders, including me a lot of the time, sell too soon. And when you chronically sell too soon, unfortunately, you're capping your upside profit potential. And the fact is, what a lot of traders do when they get into a trade that doesn't work, they get into a trade into a losing position, well, they don't sell too soon. They just keep holding. So let's just say you had a chart like this. You had a nice move up. You had a little pullback here. And then you have one of these candles where the price goes up and then it comes back down. So when you have one of these, you got in, first candle makes a new high, it squeezes up and then it drops back down. You didn't sell. And then the next candle goes red and it breaks the low. Now there's a lot of traders who just keep holding. And now you're looking at this and it's like you're stair-stepping lower. You made a new high, but it rejected. For whatever reason, it rejected. And the fact is, all your technical indicators could check out, but there's some guy in his stupid office in New York City who has a big sell order up here for 100,000 shares. And this guy just ruined the chart. It could be one order, one insider, whatever it is. He's got that giant sell order there. He's blocking the way. So, okay, whatever. It happens. Chalk it up as a loss or get out, break even, or even for a small winner if you're in at a good enough price. But do not just continue holding. But a lot of traders do this. They'll keep holding. And they won't just sell half. They'll hold full size all the way down. They're going down with the ship. And this is a problem. Because what this does to your profit to loss ratio is your average losers are big because you're holding full position down 50 cents, $1 a share or more. But whenever you have a 50-cent winner, well, you sold half when you were up 10 cents. So now, even if you sell the rest of it up 50 cents, your average winner is still only 20 cents or whatever. You sold half way too soon. That's the problem. So again, if you're selling half too soon, change those hotkeys, change those orders. So you're scaling out more slowly into the move and try to teach yourself, if you can, not to sell until you have a valid exit indicator. Again, success when it comes to reading candlestick charts can be simplified if you just focus on using fewer indicators, focusing on the best setups, and building a strategy around where your metrics are showing you have success. If you want to download a PDF of the strategy that I'm trading every single day, it's pinned to the top of the comments and it's linked in the description. You can download it, you can print it out, you can use it in your own trading and practice it. See if it works for you, because this is a strategy that I've been trading now for more than a decade full time. So if this episode was interesting and helpful, I hope you hit that thumbs up. I hope you subscribe to the channel, and I'll see you for another upload just like this real soon.